Alphabet, the parent company of Google and YouTube, reported revenue of $102.3 billion, up 16% year over year, with constant currency growth of 15%. Net income surged 33% to $35 billion, and earnings per share came in at $2.87. Behind those numbers is a story of transformation. Alphabet is no longer just an ad machine. It's becoming an AI infrastructure and subscription powerhouse. Crossing $100 billion in quarterly revenue puts Alphabet in ultra-elite territory. Even more impressive is that growth is accelerating again after a sluggish 2023. Search, YouTube, subscriptions, and cloud all contributed, and the company still posted over 30% operating margins despite the European Commission fine. Excluding that one-time fine, operating income would have been $34.7 billion, a 22% increase year on year, and operating margin 33.9%. That's world-class profitability for a business this large. Let's break down the $102 billion. Search and other ads, $56.6 billion, up from $49.4 billion last year. Search remains Alphabet's golden goose. Advertisers are spending more, and AI-driven ad targeting continues to boost returns. YouTube ads, $10.3 billion, up 15%. YouTube's strong ad growth comes from better engagement, connected TV demand, and Shorts monetization improvements. Google Network, $7.35 billion, slightly down from prior year $7.55 billion. Network represents ads sold through partner networks. Slight decline may reflect shifts as Google emphasizes direct demand and first-party inventory. Google subscriptions, platforms, and devices, $12.87 billion, up from $10.66 billion. This is the higher margin, recurring part, YouTube Premium, Google One, Play subscriptions, and device revenue. The growth here is meaningful because subscriptions smooth revenue cyclicality and increase lifetime value. Google Cloud, $15.16 billion, up sharply from $11.35 billion, a 34% jump. This is one of the most important strategic wins in the quarter. Cloud demand is coming from GCP core products, AI infrastructure, and generative AI solutions. Alphabet said cloud ended the quarter with $155 billion in backlog. That's a strong signal for future revenue and stickiness. If cloud can sustain mid-30s growth for several quarters, it meaningfully changes Alphabet's revenue mix and market valuation dynamics. Other bets, small, $344 million, slightly down. These are experimental businesses and generally cash-consuming. Continue to treat them as optional upside rather than the core thesis. Big picture, advertising still brings the bulk of revenue. Google advertising approximately $74.18 billion this quarter. But subscriptions and cloud are both growing faster and are higher margin opportunities. The diversification story is real. Ads remain dominant, but cloud and subscriptions are meaningful growth pillars. Operating income rose to $31.23 billion, a 9% increase year over year. But the report included a $3.5 billion EC fine booked in general and administrative expenses. Excluding that, operating income would be $34.69 billion, a 22% increase, and operating margin would be 33.9% instead of 30.5%. So what does this mean? The EC fine is real cash outflow risk. It's an expense, but it's a one-time regulatory penalty on a past practice. For recurring operating performance, management and many investors prefer to look at numbers, excluding this type of non-recurring item to see the underlying business trend. Even including the fine, the operating margin remains robust at approximately 30%. Excluding it, margins have expanded, showing that revenue growth and cost efficiencies are outpacing expense increases. That's a positive signal. Management is controlling the expense base while investing in key areas like AI and cloud. A striking line. Other income, expense, net jumped to a net gain of $12.8 billion this quarter. Why? Alphabet had $10.7 billion of net gains on equity securities, unrealized or realized gains on investment. This is significant because it boosted net income materially. Important investor point. Gains on investment portfolios can swing quarter to quarter and are less predictable than core operating profits. Alphabet's operating cash generation is a more reliable measure of business health. Still, these gains matter for reported EPS and for the company's balance sheet strength. Net income increased 33% to $35.0 billion, and diluted EPS rose to $2.87. Remember, EPS was materially helped by the OI&E, other income gains, and by the tax timing effects. So when you analyze EPS growth, separate operating performance from one-time financial gains. That helps avoid overestimating sustainable profit growth. Net cash provided by operating activities was $48.41 billion for the quarter, and TTM free cash flow was $73.55 billion. That's strong cash generation, but Alphabet's capital expenditures are large. The company now expects 2025 capex to be $91 to $93 billion. That's huge. Why capex is high? Alphabet is investing in data centers, AI infrastructure, servers, and network capacity to support GCP and AI workloads. They're building the physical backbone for AI service delivery. Property and equipment net rose from approximately $171 billion to approximately $223.8 billion year to date, reflecting these investments. How to think about this as an investor? Heavy capex today can produce higher margins and revenue sustainability tomorrow if it enables differentiated AI infrastructure and cloud services. But it also means free cash flow will be more variable. Capital expenditures is front-loaded. Monitor whether capital expenditure leads to revenue acceleration and margin expansion in cloud and AI services. Balance sheet highlights. Cash, cash equivalents, and marketable securities total approximately $98.5 billion at quarter end. That's a strong liquidity buffer. Non-marketable securities increased materially to $63.8 billion, reflecting long-term investment stakes. Long-term debt increased to $21.6 billion, still modest versus cash and total assets. Total assets grew from $450.3 billion to $536.5 billion year over year. Shareholders' equity rose to $386.9 billion. Overall, the balance sheet is healthy. Deep dive on cloud, $15.16 billion revenue, 34% growth. Why this matters? Cloud revenue growth at mid-30s from this base is high impact. It reduces Alphabet's dependence on advertising and moves the company into the more lucrative enterprise space. Management highlighted AI infrastructure and generative AI solutions as key drivers. Enterprises are spending on GPU/TPU capacity, data modernization, and AI model deployment. Alphabet's claim of a $155 billion backlog signals future revenue and contracts that are likely sticky. YouTube ads at $10.26 billion is growing nicely. More importantly, subscriptions and platform revenue of $12.87 billion, which includes YouTube Premium, Google One, etc., are rising fast. Subscriptions have two investor benefits. Predictability, subscription revenue is recurring and less cyclical than ad spend. Margin, subscription revenue often carries higher gross margin than ad revenue. Alphabet now reports greater than 300 million paid subscriptions across Google One and YouTube Premium, a critical metric pointing to consumer monetization beyond ads. That's a long-term lever for value creation. Other income swing. The gain on equity securities was $10.7 billion. This boosted net income and EPS by measurable amounts. Company noted an EPS increase of $0.68 tied to these gains. While nice to have, treat this as volatile. Don't assume such gains recur consistently each quarter. U.S. tax law changes enacted July 4th, 2025 allow immediate expensing of domestic R&D and accelerated depreciation for eligible capex. Alphabet noted these changes and the effects are included in operating cash flows. They may improve near-term cash taxes and cash flow metrics. As an investor, this is a tailwind to free cash flow, though watch for future legislative or accounting changes that can alter the benefit. On September 5th, 2025, the European Commission ruled that Google had infringed competition laws and imposed a $3.5 billion fine, accrued in quarter 3. That's material, but not existential. Regulatory risk is real and ongoing. Fines are a cost of doing business at scale in multiple jurisdictions. The fine is substantial but manageable relative to earnings and cash. It reduced operating income for the quarter but didn't alter the growth narrative. More importantly, regulators may pursue remedies beyond fines. Behavioral changes, restrictions, or mandated product changes could affect business models. Watch regulatory developments in Europe and other regions. Other bets lost $1.43 billion in operating loss and generated $344 million in revenue. These are exploratory technologies, Waymo, Verily, etc. Historically, other bets consume cash and occasionally produce strategic value. As an investor, treat other bets as optional upside but not yet earnings accretive. Monitor changes in capital allocation to these units. Bottom line, Alphabet's Q3 2025 shows a company operating at scale, hitting a new revenue milestone, and pivoting toward AI and cloud through massive investments. The EC fine and big investment gains are noteworthy, but don't overturn the core story. Diversified revenue growth, very strong cash generation, and strategic investment in AI infrastructure. The primary question for investors is whether heavy capex will translate into sustained revenue and margin upside from cloud and AI. If you believe Alphabet can convert capex into higher margin recurring AI/cloud revenue, the long-term case is compelling. Otherwise, the stock could face pressure if capex dampens free cash flow without clear revenue. Payoff earnings releases are a snapshot, but the story that lasts is how management turns investments into durable revenue and profit. Alphabet's Q3 2025 shows clear execution, multi-product growth, major cloud momentum, and an AI-first investment stance. That's a long-term story. The next chapters will be about capital expenditure returns, cloud margins, and how regulators shape the competitive landscape. Thanks for watching. I'll see you in the next breakdown.